Hello, everybody. Welcome to this week's edition of Northwest Quadrant Wealth Management E-News. Thank you for joining us. So we got some inflation data this week that was a bit better, meaning inflation was trending lower, albeit slightly. And so for the most part, inflation is sort of flatlined here. It still continues to move in the right direction, but very, very slowly. And so Josh and I have come to the conclusion that the Federal Reserve is in one of two camps, and we're not sure, and maybe we'll have some clarification on that at their September meeting. The first camp is that the Federal Reserve is sort of implicitly okay with higher inflation without actually saying it. So they might be actually okay with saying internally that a 3% inflation rate is tolerable for now. And they understand that, and maybe in September, if they're cutting, that means that they're definitely okay with a 3% inflation rate. The other side of the equation, and this is the camp that I fall in, is that the Fed knows that if you look back throughout history, in dealing with high levels of inflation, the only solution to dealing with those high levels of inflation throughout history was for the U.S. economy to go in a recession. And if you look at the big drivers of the inflation data right now, namely shelter, so housing costs, there's a problem because we have a supply problem in the housing market, and so house prices continue to appreciate. The housing market's the least affordable it's ever been in the history of our country, and so the only solution for that is a recession. And so the only solution to high levels of inflation in this country's history was a recession. And so I think that the Fed is probably okay with the idea that, yes, we're going to have a recession in order for inflation to really get back to their 2% target level. So those are sort of the two camps we think the Fed is in without actually saying it. The monetary policy that the Fed is employing right now is marginally restrictive. The U.S. economy is still pretty robust, and there's lots of crazy spending going on out there right now. And so it's hard to imagine that it's very restrictive. So either the Fed leaves rates where they are for much longer than anybody thinks they're going to, and we do eventually fall into somewhat of a recession, and once people start to lose their jobs, then that takes care of the housing market inflation. I think that's probably more likely where they'll end up. Or the Fed says, you know what, even though we're saying our target is 2%, we're really okay with a 3% inflation rate. And if they cut in September, then that's what they're telling all of us. And so obviously, what does that mean for your money? Josh can sort of describe how we think about it as it relates to our portfolios, because there's sort of maybe a third scenario that nobody can think of.
Well, the real lesson is to always stay invested no matter what the Fed does. And working in the business for over a decade now, it's sort of a travesty that half my career has been spent laser focused on ultimately what the Fed does, and fundamentals have mattered less than any time in the last 50 years. But it's quite surprising to see Tyler do a little bit of an about face and believe that the Fed finally has some credibility and think that they know what they're doing, and give them a little more credence, and that they will ultimately hold rates for higher for longer. But again, like you mentioned, we'll have a pretty definitive answer, I think, by September. What's really clear, though, is when there are weak data points that this market seems to be quite precarious and not so susceptible, and very susceptible to bad news. So we're certainly on that razor margin where bad news will be treated as bad news. Remember, up till this point in the year, bad news has actually been treated positively by markets, in that just meant that interest rate cuts were coming sooner than later. But the main takeaway for everyone is, regardless of Fed decisions, you got to stay invested. We haven't made any big portfolio tweaks as of late, but ultimately staying invested in time in the market is all that matters.
Yeah, so remember, if they are aggressively cutting interest rates, that means we're in a recession, and so nobody really wants that. I feel like we're in this sort of Goldilocks situation. I would tell you that we haven't had any real volatility to the downside in quite some time, and April was a little bit rough, but it wasn't that bad. And so I would expect volatility. That doesn't mean we're going to be doing anything, or we think you should be doing anything, but you should be expecting volatility because we've had so little of it so far in 2024. All right, if you have questions about your situation or your account, give us a call, 877-670-7117, or you can send us an email, Josh or Tyler at northwestquadrantwealth.com. We'll see you back here in 2 weeks.